This is the Retirement Solution Podcast with financial advisor John Hicks, founder of J. Hagan Capital.
Thanks for being here with us on the Retirement Solution. I'm Heather Branch, here with John Hicks, financial advisor, founder of J. Hagan Capital, father, husband, son, dog lover.
Yes.
Baseball lover. The list of accolades goes on and on.
The list of accolades goes on. Yes. It may not be quite like Bruce Wayne or anything like that. Playboy billionaire by day.
That we know.
Vigilante at night.
You can't reveal
cleaning
all
up the dirty
of your
streets
secrets.
of Kentucky. I know. I try. It's hard. It's hard to keep that image in check.
You're doing great.
Please.
You're doing great.
It depends on what day it is. Half the time it's daddy, and I've done something terribly wrong. Like washed a pair of socks.
How dare you?
Absolutely needed to be washed. There's no question, because I thought something had died in a room. But those were the lucky socks for the flag football.
I was going to say,
daughter.
socks is one thing. I would think that'd be more of a boy thing, but your girls are athletes. But I would think like the jeans. Be very careful with the jeans and/or the jean shorts, Dad. If you ever
So I learned that from my wife. I learned that I was not supposed to wash my jeans every single time I've ever put them on.
You're not.
Which is great because I never did it. Anyway, but I learned
now it's like valid.
Yes, that denim is a different fabric.
It is a different fabric.
So it's fine. Yeah.
All right.
So yes.
You talked about Bruce Wayne. I think that in some cases you certainly act as a superhero to some people when it comes to the work that you do.
Oh my gosh!
I want to bring up your.
So not true.
I want to bring
Maybe
up
the Joker.
No. We're not joking about money. This is very important, especially when it comes to. I want to talk about your favorite thing. I want to talk about your least favorite thing, taxes, but your favorite thing, which is working to not have people that you work with pay as much as they would if they didn't know you. Because, I don't even know if there's any real opportunity based on what we saw with the market a few weeks back, and there was that down dip, but then things have come back. Even still, it's worth maybe evaluating market portfolios, because the idea of tax loss harvesting, I say it slowly, because I think it's a term that gets thrown around, but do people really know what it is or how to make it work for them? It actually, I feel like it tends to come up more often this time of year in the fall and Q4, people start thinking about it. But there was an article that I read talking about how this tax strategy is becoming more popular year round, given volatility in the market and looking to have opportunities for this tax loss harvesting. So let's talk about it. One, give us some explanation about what it is and how it could work for somebody and how you have made it work for people that you work with.
Yeah, so when it comes down to finding a way to give the government the least in the form of taxes that we're legally obligated to do, right? That's the biggest thing. We always want to make sure we do everything legally.
Of course.
But there are so many loopholes, so many ways that we can reduce the amount we owe the government. Tax loss harvesting has been used for decades, but essentially it's where if you have a stock position and you've lost money since you've owned it, you can actually sell that position and potentially, if it's in a taxable account, record a tax loss up to $3,000 on your regular 1099.
Okay.
So if you basically had a $3,000 loss in your NVIDIA stock, it's been hit kind of hard over the past several months, but if you have lost $3,000, you could, if you chose, sell a portion of that to have to recognize a $3,000 loss and potentially write that off your taxes that year. Now, you need to wait at least 30 days to buy that stock back, or the government wipes it out. So there's some various ways that you can change things.
Yeah.
Some people just kind of want to divest a little bit anyway. But tax loss harvesting can help you a little bit with a lot of things. But this is a big one, Heather.
Okay.
No one ever talks about it. I go to CPA groups all the time. I go to symposiums where we have everyone talking about all the great ways to deal with financial advisement when it comes to taxes. Almost no one talks about capital gain harvesting.
Okay. Yeah.
This is a big one. This is a huge one. And no one ever talks about it.
Okay.
To the point where I looked it up before we went on the show today. I found only 3 articles about tax gain harvesting over the entire interwebs. As opposed to tax loss harvesting, there were thousands.
Capital gains harvesting.
Capital gains harvesting.
Versus
so let's talk
tax
about that.
loss harvesting. Okay.
Yeah. So basically, what happens if you have that exact same, in this example, NVIDIA stock or Microsoft or Home Depot or Starbucks or Lowe's or whatever you got, and you actually have a good amount of gain? Now, you don't want to sell that stock because you like it.
Right.
At the same time, even if you wanted to take a little bit of position off, you don't want to pay taxes on it. But if you're in the certain tax bracket, if there are 2 tax brackets you can be in, and you can potentially sell that stock, recognize a gain, and still pay 0% capital gains rate. What? Whoa. Hold on, John. What you're telling me is that I can sell an appreciated asset and potentially pay no capital gains on it if I do something shrewdly and I'm in one of 2 different tax brackets. Yes, that's exactly right. Those are those things that make a big difference. So, for example, let's use this as a perfect case example.
Okay.
Let's assume that you're retired. You have your Social Security coming in, not a whole bunch of other income, but you don't need that much more. But you have a lot of stock in whatever that company is. Doesn't matter what it is. But you realize, man, at some point in time, if I ever want to sell that, if I ever want to take some money off the table, the Uncle Sam may get me for 20% on my money. That's capital gains rate. But if you position things correctly, we typically do this by asset shifting. You could potentially sell maybe all of that stock position, recognize the gain, and pay 0% capital gains, which saves you 20%. And depending on some tax brackets, you are also going to avoid that 3.8% NIIT tax. That's right. They don't even talk about it that much. And it's not a tax on T. NIIT, net investable income tax, net investment income tax.
Okay.
So NIIT. So if you typically are in a higher tax bracket, you're going to pay 20% plus 3.8. That's 24%. Now that's before the state gets anything from you, right?
Yeah.
So closer to 30% capital gains for most of us. However, done correctly, you can potentially avoid maybe all of that. But you got to actually understand what you're doing and what you're trying to solve for, right?
Yeah.
That's a big deal. So capital gain harvesting, big one.
Okay.
We use it all the time.
Okay. All right. So tax loss harvesting, capital gains harvesting, obviously questions that we need to be asking. If you work with the CPA and or financial advisor and you ask these questions and they look at you cross-eyed, maybe it's time to get a second opinion.
Absolutely.
We were talking about the time of the year because the idea of tax loss harvesting, it does come around this time of year, as does tax planning generally. One thing that I think that you have worked to teach us is we should be thinking about tax planning all year, not just one time of year. So that notion aside, are there things that we should be thinking about focusing on this time of year, end of year stuff, if you will,
Without
in the
question.
way of
Without
planning?
question. There are some big ones. Number one, have you fully funded your 401k, right?
Okay.
A lot of people, they say, I'm going to put in $200 a paycheck, da-da-da-da-da-da. But they don't realize they may be sitting on $40,000 or $50,000 in their bank account, their checking account.
Yeah.
They don't need the extra money right now. Why wouldn't you go ahead and do an end of the year contribution to your 401k and get a bigger tax deduction? Right? Because you may also get a company match on top of that. So look at those things this time of year. That's a big one. And a lot of people, it's just like, well, I put in $6,000, but wouldn't it be better if you put in $16,000 or $15,000 or whatever your maximum is in that situation? Of course it would be. So there's one thing to consider. Number two, you want to look at, should you do any asset shifting? A lot of folks, they get to this time of year, they kind of know within reason if they're going to get any more pay raises or salary bumps or major sales. So they can kind of understand what about a taxable income bracket they're going to be in. If they know that, it may be a good time to start looking at shifting assets. Should you go from a tax-deferred account into a tax-free account? Should you take money in your taxable bank account and put it into a Roth? Should you put it into a traditional IRA? Do you have way too much money in money market accounts, and you are not only going to earn lower rates of return as interest rates drop, but you're also being charged taxes on that amount. So most people don't recognize if you're in the 24% tax bracket and you get a 5% money market, you're really only getting about 3.6% of that. The rest of it goes to pay taxes to Uncle Sam. But you could defer those types of gains. You can use fixed annuities. You can use any kind of principal protected notes. There's many things you can use to defer the taxation on that. And you can potentially pay no taxes, at least for now, on those dollars. And lastly, and this is a big one because most people are unfamiliar with the concept of doing a backdoor Roth. What does that mean, John? Backdoor Roth. Many 401k companies out there allow you to take after-tax money. So I've been talking a lot because I know there's a bunch of you out there. You've got a whole bunch of money that's sitting in your bank account. Mm-hmm. Yeah, you don't know why it's there. You just didn't want to invest it. You like getting 4 or 5% on your money, and you just wanted to go ahead and leave it there. But you may have hundreds of thousands of dollars. If you're still working, your 401k may allow you to take a portion of that after-tax money, put it into your 401k at work, and then immediately convert that to a Roth. The maximum that the IRS allows is $60,000 a year, Heather. No one understands that rule. It is a huge one, especially if you don't need some of that extra money in your bank account. Yeah. What if you bought that 4.5% or 5% CD in a Roth? What's your taxation on that? 0. So you have to understand there are often shrewd tax strategies we can use just because we know better. And this time of year is a great time to do that. There are more CDs that are going to mature in October than in any other month of the year in the United States. And there's going to be all kinds of people that are looking at those decisions. Should I roll this into another CD? It's not going to pay as much as the last one. Should I do a backdoor Roth? Should I put this in a Roth? Should I do whatever? These are things that my team is really good at helping answer, not only come up with the possibilities you could use, but just finding out what is the most beneficial to your situation. Some people, they have this idea that they're paying way too much in taxes, and we look at it on paper, they're in the lowest tax bracket. They shouldn't be focused on taxes. They should be talking about doing capital gains harvesting. That's what they should be doing. They might be able to save fortunes in the long run as they gift those things to their kids and grandkids. Those are the things that make the biggest difference. It's a great time of the year to do any of those things.
Time to get to work on it. If you have questions about how capital gains harvesting might work for you, or if you want to know more about asset shifting and backdoor Roth options, this is what John and his team do every single day. They are here to help you figure out what will work within your own investment plan. Visit us at retirementsolutionradio.com so we can start this conversation with you today. We also have links posted in the show notes, or again, it's retirementsolutionradio.com.
Thanks for listening to the Retirement Solution Podcast with John Hicks. Begin the conversation about your savings plan with John and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to John's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Inc. is not licensed in all 50 states. To find out if J. Hagan Capital Inc. is licensed in your state, please call 502-690-5635. J. Hagan Capital Inc. is not affiliated with nor endorsed by the Social Security Administration or any other government agency. It does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital. National license number 1882794.